Today, we are strapping in for a terrifying look at the financial system's near-death experience. A moment where everything we thought we controlled about money just turned on us at the speed of light.
We are diving into Black Monday, October 19, 1987. And our mission really is to dissect what happened in those chaotic, almost unbelievable 6.5 hours of trading.
Right. How did the global market just vaporize? I mean, the number is an estimated $1.71 trillion in wealth.
And with no specific war, no huge natural disaster, nothing you could point to on the news and say, that's the reason. The answer was, well, it was code.
This was the first time we really saw a digital ghost in the financial machine.
And it nearly brought down the entire global economy.
Okay, so let's try to unpack this. We like to use a structural metaphor for these deep dives because we're really looking at the seconds that can change history. So think of history as a giant dam holding back pressure. The water rising behind it, that's the years of, slow crushing buildup. Economic tension, unchecked optimism. For us, that was the roaring 5-year bull market of the 1980s.
And the crack in that concrete, the fulcrum moment that finally breaches the dam, that happens in the time it takes to trade a stock. The few hours of trading on Black Monday, when these sophisticated automated systems, which were designed for safety,
Right, for safety.
they turned completely against their masters.
And what follows then is the flood. That's the consequence, the systemic failure, and all the regulatory scars we live with today. I'm thinking primarily of the invention of the circuit breaker.
Exactly. And we have to recognize the core paradox here. This wasn't a failure driven by, the usual suspects like market manipulation or just pure greed.
It was a failure of logic.
A failure of collective logic. It was the moment that the rational, independent actions of thousands of computer programs combined to create an outcome that was just utterly, globally catastrophic.
It's a compelling story because it really challenges this assumption we have that complex automation is inherently safer.
It is. In 1987, we built the financial world a digital safety net, and that net almost strangled the patient.
So here's the roadmap for this deep dive. First, we're going to trace the immense pressure building in that superheated market between 82 and 87. And we're going to focus heavily on the creation of the system's most dangerous component, portfolio insurance.
Then, we step inside the crash day itself.
Yeah.
We want to understand the exact mechanics of that algorithmic feedback loop.
And crucially, we'll look at the silent systemic failure that happened the morning after the crash. That was the true near miss.
And finally, we'll analyze the single decisive human decision that averted a second Great Depression, which led to the coded scars we now call circuit breakers.
All right, let's start with that rising water, the pressure stored in the system, the 5-year fever. From 1982 on, this bull run was just relentless. It was setting the stage for a total structural failure. Just how unprecedented was this?
Oh, it was unprecedented in both speed and intensity. The Dow Jones Industrial Average, the DJIA, was sitting at a humbling 776 points in August 1982. Yeah, and this was coming off years of economic stagnation, high inflation, the malaise of the 70s. But then the engine just turned over.
And from that modest starting point, the market found rockets. What was driving this incredible confidence?
It was a convergence of a few big factors, but primarily deregulation and a profound shift in market psychology, fueled by Reaganomics.
Okay, break that down.
Well, the sources really highlight that the 1980s saw significant corporate tax cuts, which, boosted corporate profits almost instantly. And the whole atmosphere of deregulation lowered barriers to entry for financial innovation, and it encouraged some really aggressive risk-taking.
So there was a sense that the government was almost actively encouraging the party to keep going.
That's a perfect way to put it. The feeling was that the good times were here to stay, and that the corrections and downturns of the 70s were a thing of the past.
So this wasn't just a market moving up, it was a psychological phenomenon. This bull run created a real sense of invulnerability.
Absolutely. The market psychology completely warped. Analysts at the time noted that investors stopped looking at market corrections as, warning signals to pull back.
Instead, any little dip was a buying opportunity.
A golden, temporary buying opportunity became self-reinforcing. Dips were bought up instantly, which just trained the market to believe that dips didn't matter. And this created a massively, dangerously overvalued market.
To put a number on that zenith, the DJIA peaked at an incredible 2,722 on August 25, 1987.
That's nearly a 4-fold increase in just 5 years.
You had stock values that, by almost any measure, far, far exceeded their underlying earnings and worth. The system was storing just immense potential energy waiting for a trigger.
And crucially, this superheated environment gave birth to the ultimate risk mitigation tool of the decade, the very technology that would become the dam's main weakness: portfolio insurance.
Okay, how could something called insurance be the weak spot? We really need to define this because for anyone listening, understanding portfolio insurance is basically understanding the villain of the whole story.
It sounds so benign, right? But portfolio insurance was this revolutionary automated strategy. It was used mainly by huge institutional investors, pension funds, mutual funds, that sort of thing.
So it's not like car insurance where you pay a premium.
No, not at all. It was an internal algorithmic strategy, a set of rules programmed into a computer.
So what was the core logic programmed into these computers?
The logic was seductively rational. It was a form of what's called dynamic hedging. These big funds, they wanted to participate in the huge bull market gains, but they needed a way to automatically protect the profits they'd already made if a crash started.
Makes sense.
The system operated on a really simple set of rules. If the market index fell by a specific amount, say 3%, the computer would automatically sell a predetermined volume of S&P 500 futures contracts.
Wait, okay, why futures? Why not just sell the underlying stocks?
That's the key. Because futures contracts are far more liquid and efficient to trade in huge volumes, and they require less capital up front. A single S&P 500 futures contract represents a huge block of stock value. It's just a much faster way to adjust your risk exposure. By selling these futures, the fund was effectively betting against the index, hedging their physical stock portfolio against a major decline.
I see. So the system is constantly watching the market. If things are calm, they just hold on. If the market drops, the algorithm kicks in and issues these massive sell orders for futures contracts to balance things out.
Exactly. The key word is dynamic. It created this incredible illusion of safety. If you're a portfolio manager running say, a $10 billion pension fund, this was genius. It promised downside protection without the high cost of options or the slow process of getting human approval to sell billions in stock. They thought they had conquered risk with code.
But you mentioned the fatal flaw. What happens when every major institutional player, driven by the exact same rational desire for self-protection, buys the exact same safety net?
The safety net becomes a tripwire. The system only works if you're one of a few people selling. When everyone adopts the same set of coded instructions, if price drops, sell large volumes of liquid futures, you completely eliminate the possibility of finding a buyer on the other side when you need one most.
You create a unified, automated response to fear.
A completely unified response. And the market started showing signs that these machines were winding up for a major release. We need to look at the instability in the days just before Black Monday. This is the moment the dam really began to groan.
So the anxiety was building.
It really started to spike on Wednesday, October 14th, 1987. The DJIA dropped a pretty substantial 95.46 points. That's a big number for 1987. The market set the next day trying to stabilize, but then came Friday.
Friday, October 16th, that was the point of no return.
Precisely. On that day, the DJIA fell another 108.35 points. This was, at that time, the single largest one-day point drop in the history of the Dow. It was a clear, unambiguous signal that the bull run was deeply wounded.
And that Friday decline meant that over the weekend, every single computer-running portfolio insurance across the country registered a substantial loss. Their coded instructions were now loaded, aimed, and just waiting for the Monday opening bell.
Exactly. They weren't feeling anxiety or hope or confusion, just cold, hard code waiting for the execution moment. The market closed on Friday with the machines effectively pre-programmed for panic.
So analysts and sources confirmed that the conditions were now set. Any slight opening lower on Monday would push the index past that next preset trigger point.
And the resulting sell orders would be astronomical in volume. The conditions for the digital avalanche were now perfect.
Which brings us to the moment of truth. 9:30 a.m., October 19th, 1987, the digital avalanche. This is the fulcrum moment where the dam truly breaks. Walk us through the environment that morning.
The contrast is key here. On the floor of the New York Stock Exchange, you had the chaotic physical system. Shouting, paper flying everywhere, human traders trying to read the fear in each other's eyes. The adrenaline was running high, everyone on the phone trying to call banks or clients to figure out a plan.
But the real attack was silent. It was coordinated, coming from computer terminals miles away in these institutional trading floors.
Yes. The machines had spent all weekend calculating based on Friday's severe decline. The moment the bell rang, the pre-programmed sell orders were just unleashed. We're talking about an order of magnitude spike in volume, instantly. The system could not cope.
And the sources really emphasized the breakdown of market information. We hear about the ticker tape falling hopelessly behind. What does that actually mean for a trader on the floor?
It meant utter blindness. The ticker tape, which shows you the price of the last executed trade, was lagging by several minutes. By midday, it was sometimes an hour behind.
An hour?
An hour. So traders on the floor saw a stock selling at, say, $50. But the reality, the price being driven by the computers in real time, might already be $40. They were trading on ghost prices, reacting to completely stale data. Their human intervention was useless against the velocity of the computer-driven panic.
And the speed, it brings us to the fatal design flaw of portfolio insurance. Its blindness and its massive scale leading to this collective disaster. Economist Robert Shiller's analysis is really vital here.
Shiller, and later the Brady Commission, they realized this wasn't just a market correction based on bad economic news. It was significantly, catastrophically exacerbated by the mechanics of portfolio insurance. The algorithm only knew one command. If the market falls, sell. It had no context, no ability to look around and realize that by selling, it was causing the very market decline it was designed to protect against.
It's the stampede analogy perfected. One person running for an exit is rational. Thousands of identical systems running for the only available digital fire exit at the exact same time is catastrophic.
And that stampede was perfectly channeled through the most efficient digital artery we had at the time.
Yeah.
The relationship between the stock markets and the futures markets. This is where we need to explain the mechanics of the death spiral.
Okay, let's break down that terrifying closed feedback loop step by step.
Okay. Step 1. The trigger. The market opens slightly lower, just reflecting the deep anxiety from the weekend. This initial dip pushes the index past the first trigger points programmed into the portfolio insurance algorithms. They all fire simultaneously.
Step 2, the futures crash. So these algorithms execute massive sell orders for S&P 500 futures contracts, which are mostly traded in Chicago. Because the volume is so immense and coordinated, the futures market just instantly plunges.
Step 3. The arbitrage mechanism engages. This is the critical non-human link. You have these index arbitrageurs. These are sophisticated programs designed to keep prices in sync. They see the futures plummeting in Chicago, while the underlying stocks in New York are still priced higher.
And their programs are designed to profit from that difference.
Right. But in the process of profiting, they execute the next phase of the crash.
So the arbitrageurs are forced to sell the physical stocks on the NYSE floor to drive those prices down to match the falling futures prices. They aren't panicked, they're just following a simple profit-seeking rule.
Exactly. They are mechanically transferring the panic from the highly liquid futures market into the physical stock market. They are the digital transmission belt of the crash.
Step 4. The loop closes. And this mass selling of stocks by the arbitrageurs pushes the overall market index even lower.
Which then triggers a new, even larger wave of automated portfolio insurance selling, because the price has now fallen past the next programmed trigger point.
And the cycle just accelerates violently, minute by minute.
It is. The selling just feeds on itself. It's driven by cold, relentless logic, not human emotion or any consideration of the underlying value of these companies. The system was behaving exactly as it was designed to. But the collective rational action was catastrophic. It was a machine in free fall, and no human could interrupt that logic chain once it started.
That technical detail, that it's the arbitrageurs mechanically transferring the panic, that's so crucial. It wasn't the portfolio insurance managers themselves directly overwhelming the NYSE.
No, it was their sales in the futures market, forcing the index arbitrageurs to sell the physical stocks to maintain that price parity. And these arbitrageurs, they're huge institutions themselves, dealing in massive blocks of stock. This cascade meant that when human traders on the NYSE floor finally realized what was happening, they were already minutes behind, just staring at this accelerating index and realizing the selling was now entirely self-generating.
The sources called this the digital DNA of the crash, a perfect weapon aimed squarely at its creators.
The psychological terror must have been immense, to realize that your years of experience, your gut feelings, your analysis of company fundamentals, none of it matters.
None of it. Not against the speed of electricity and a system of coded rules.
And the records show that the Dow plummeted 250 points in the last 90 minutes of trading alone. The computers were not slowing down. They had no margin call, no emotional fatigue. They were following the rules, and the rules dictated total liquidation.
Let's move to the physical consequences. Section 3 covers the Black Monday tally, the sheer scale of the disaster. But then, and this is key, it focuses on the terrifying event that happened the next morning, the near miss.
The numbers still shock. Over those 6.5 hours of trading, The DJIA dropped a total of 508 points.
Which is devastating, but the percentage is what really matters.
The percentage is what matters most. It was a 22.6% drop. That remains the historical high watermark for panic. You could look at the 1929 crash, which was certainly worse in its long-term economic effects, but the single largest percentage drop in 1929 was less severe than what happened on Black Monday. This was just pure, unadulterated velocity.
The value that just...
It was staggering. An estimated $500 billion was lost in the U.S. market alone. Globally, that translates to an estimated loss of 1.71 trillion U.S. dollars. That is wealth just disappearing instantaneously simply because the machine decided to panic.
But here is the critical pivot of our deep dive. The crash itself, the market hitting the floor, that was the noise, the symptom. The true crisis, the systemic threat that could have plunged the world into a second Great Depression, happened the morning after, on Tuesday, October 20th. This is the critical near miss.
Right. You have to shift your focus entirely from stock prices to the liquidity crisis. This is the moment the internal plumbing of the global economy completely seized up. The system stopped working because the flow of cash, the lubricant of all commerce, froze solid.
Why did the system freeze?
Right.
We need to explain the mechanics of how trades settle. In '87, trades operated on a T+5 settlement basis, right? So you had 5 days to pay.
Right, but the clearinghouses, they needed collateral immediately.
Explain the clearinghouses.
Okay, so the core function of the market depends on these institutions, like the Options Clearing Corporation, the OCC. They guarantee that every single trade will be settled. After Monday's crash, brokerage firms owed colossal sums, hundreds of millions, potentially billions, to the clearinghouses to cover their clients' losses and margin calls. They needed vast amounts of cash right then to post as collateral and just remain solvent.
But the institutional clients facing these huge sudden losses, they didn't have the cash in hand either. So the brokerage firms, who are basically middlemen, had to go to their banks to borrow the money to cover those obligations.
And this is where the banks, the very foundation of the credit system, looked at the brokerage firms and saw a giant, unpredictable black hole of risk. They saw firms that were perfectly solvent on Monday night suddenly facing potentially existential debt by Tuesday morning.
That must have been terrifying for the banks. If they lend money, they risk losing it entirely if that brokerage firm goes under.
They became paralyzed by fear. The banking sources confirm it. The banks just started hoarding cash, refusing to extend credit to the brokerage houses. The lending window slammed shut. The dam hadn't just breached. Its entire foundation was cracking.
So if the banks stop lending, the brokerage firms can't pay their debts to the clearinghouses. What happens next in that chain?
If a major brokerage firm defaults, say it fails to post the required collateral by the clearinghouse's deadline, it sets off a chain reaction. The clearinghouse, now facing its own shortfall, could become insolvent. The banks that held credit lines for that clearinghouse would then be in danger. And the banks that had lent money to the defaulting brokerage would also face catastrophic failure.
That's the threat of a complete financial meltdown, a system-wide chain reaction of insolvencies that analysts agreed could have dwarfed the Great Depression, where bank failures were the real driving force of the economic downturn.
The Brady Commission, in its official report, it noted this terrifying distinction. They said Black Monday might have been frightening, but it was the capital liquidity problem on Tuesday that was horrifying. The economy had survived the crash, but is now bleeding out, and nobody knew how to stop it. Senior figures have confirmed they were hours away from major, well-known brokerage houses defaulting.
The titans of Wall Street spent that Tuesday morning in what I can only imagine was a quiet, desperate panic. Stock prices were completely irrelevant compared to the need for cash flow. They needed a signal, a massive injection of confidence, or the entire engine of the global market would seize up permanently.
The situation demanded not just money, but a promise that the system itself would not be allowed to fail, a guarantee that would convince those paralyzed bank lenders to start moving cash again.
And that signal came. Which brings us to Section 4, the one-sentence solution. This is where the human element, informed by history, finally overrides the machine panic and saves the global economy. And the key figure here is Alan Greenspan.
Greenspan was the newly appointed chairman of the Federal Reserve. He was only 2 months into his tenure.
What an introduction to the job.
Can you imagine? He wasn't just facing a stock market crash. He was facing a global crisis of confidence that threatened to define his entire career as a catastrophic failure.
And he had to make his decision under the terrifying shadow of history. The ghost of 1929 was haunting the Federal Reserve.
Absolutely. The fatal error the Fed made after the 1929 crash was tightening the money supply. They believed in this policy called liquidationism. Let the weaker banks and weaker firms fail.
The idea being that it would purge the system of excess risk and moral hazard.
Right. But the result of that tightening was a catastrophic lack of credit, which led directly to the cascade of bank failures, mass panic, and the Great Depression. Greenspan knew he had to do the exact opposite.
He understood that on October 20th, the problem was not price, it was credit.
Exactly. He couldn't order the market up, and he couldn't just bail out individual firms with taxpayer money. But he could control the supply of money itself. He needed to reintroduce confidence, and he needed to do it immediately before the NYSE bell rang.
So just before the market opened on Tuesday, October 20, 1987, the Federal Reserve released a brief, almost terse statement. It was only 45 words long, but it was perhaps the most consequential 45 words uttered that entire decade.
It was the decisive action. It was a piece of financial coding written in plain English that changed the flow of capital instantly. Greenspan and the Fed affirmed their readiness to serve as a source of liquidity to support the economic and financial system.
Okay, here is where the deep dive really clarifies the meaning. That sentence wasn't directed at the screaming traders on the floor or the panicking public.
No.
It was a direct, unambiguous promise to every single bank in America. It was the ultimate system-wide, we've got your back.
It was an immediate de-risking of the entire lending environment. The message was crystal clear. Lend the money to the brokerage firms that need to post collateral. Do not worry about their credit risk, because if they fail, the Federal Reserve will make sure you, the lender, do not fail. We will inject unlimited liquidity if necessary.
And that is the crucial difference. It wasn't a bailout of the failing firms. It was a guarantee to the banks that facilitated the necessary lending. That human promise, delivered by the nation's central bank, it just snapped the machine's feedback loop of paralysis. The system's plumbing thawed instantly.
Money started flowing again within the hour. Banks began lending to the brokerage houses posted their collateral, and the clearinghouses survived. The ghost of 1929 was exorcised, not by avoiding the crash, but by making the exact opposite policy decision after the crash.
The systemic failure was averted, and the sheer power of that single, well-timed, authoritative promise pulled the global economy back from the brink of a second Great Depression. The recovery that followed is the ultimate proof of how effective it was.
The market began its rebound immediately. The DJIA clawed back 288 points of that 508-point loss within just the next few trading days. And unlike 1929, a prolonged economic recession did not follow. The market, remarkably, had recovered virtually all of its Black Monday losses by September 1989. The core lesson was established. A liquidity crisis, no matter what causes it, must be met with overwhelming liquidity support.
So the immediate crisis was averted by a powerful, concise human promise, but the algorithmic shockwave left permanent scars on the financial structure. Let's talk about the flood of consequences in Section 5, starting with the postmortem, the Brady Report.
The Brady Commission, which was formerly the Presidential Task Force on Market Mechanisms, was established right after the crash to figure out exactly what happened. And their core finding was revolutionary for the time. They concluded that the stock market and the futures market were not separate entities. They were a single, highly integrated system, which they termed one market.
And because they were one market, a panic that started in the futures market could instantaneously destroy the stock market. The conclusion was terrifyingly simple. The crash had just happened too fast.
Way too fast. The algorithmic panic falling prices triggering automated selling it moved at the speed of electricity. There was no human intervention possible in the immediate moments of the crash. The system lacked a built-in off switch. And regulators realized they couldn't trust the automated systems, or even the humans, to react properly under that level of pressure.
The direct consequence of that was the institution of trading curbs, which we all now know as circuit breakers, implemented in 1988. This is literally the coded electronic memory of the Black Monday chaos.
They are the direct technological answer to the systemic failure of 1987. Their function is purely mechanistic and automated, to automatically halt all trading when the market falls by a certain percentage threshold, measured by the S&P 500 index.
It forces a mandatory immediate timeout. Whether it's for 15 minutes or the rest of the trading day, all trading just stops. It's an electronic kill switch designed to break that feedback loop.
And the purpose is singular, to prevent the market from vaporizing its own value, like it did in 1987. It forces the computers to stop selling, it allows market makers to catch up on pricing, and crucially, it allows humans, traders, executives, regulators, time to breathe, consult, and think rationally.
We should probably detail the structure because it's not just one circuit breaker, right? The rules they put in place establish tiers of halts.
Exactly. They're calibrated to reflect increasing levels of danger. Originally, the triggers were set at 10%, 20%, and 30% drops. Today, the rules are defined by three market decline thresholds based on the S&P 500's close from the previous day. Level 1 is a 7% drop, Level 2 is a 13% drop, and Level 3 is a 20% drop.
A level 1 or level 2 halt forces a 15-minute timeout, as long as it doesn't happen too close to the end of the day.
Right. But the level 3 halt, that 20% drop, that's the ultimate kill switch. If that is triggered at any point during the trading day, the entire market is shut down for the remainder of the session. That is the regulatory scar from 1987 that screams, "We will not let the machines kill us again."
So the lasting impact is that every single time you see markets halted on the news, which we saw several times during the 2020 COVID panic, you are witnessing a direct, codified echo of Black Monday. You're seeing the moment the market's electronic heart stops beating for a timeout based on the fear that that algorithmic ghost might reemerge.
It's the permanent electronic memory of that crisis. It ensures that algorithmic logic can never again accelerate a crash with that level of unchecked speed and volume. It's a mechanism designed to protect the system from its own collective, automated rationality.
This deep dive really reveals that Black Monday was fundamentally a warning shot from the future. It was a crisis that was simultaneously historic in its scale and futuristic in its mechanism.
It was the first time we built a system designed to conquer risk, using cold logic to remove human emotion, only to discover that we had inadvertently created a new, colder, and infinitely faster form of panic. The machine proved it could think and panic faster than its creators.
We built systems to protect us from our own emotions, only to discover we had created this profound systemic fragility. And while we have circuit breakers now, that fundamental vulnerability hasn't been solved. If anything, it's only been amplified exponentially.
That is the crucial lingering vulnerability. The portfolio insurance algorithms of 1987 were simple ancestors operating on mainframes. The high-frequency trading systems of today are infinitely more complex. They operate in microseconds. The feedback loops don't operate in minutes. They operate on signals no human can even perceive.
So the ability of a human, even a Fed chairman, to identify the problem and pull a plug is dramatically reduced when the critical action takes place in milliseconds. The vulnerability is still there, just hidden behind a much higher speed threshold. The moment of truth has shifted from 6.5 hours to maybe 6.5 seconds.
The world avoided a decade of ruin in 1987, not because the crash was insignificant, but because of a single, calculated human decision. And it was based on the humility of lessons learned from the past, the tragedy of the 1929 Fed response. Greenspan defied the prevailing economic orthodoxy of his time by choosing intervention over liquidationism.
It's a sobering thought that our salvation came from historical memory, not from technological superiority. So what happens when the next algorithmic glitch moves too fast for a human to even notice it, much less intervene? What other complex systems are we relying on right now that might have a similar unseen digital ghost in the machine?
Black Monday reveals the profound fragility of these interconnected systems that we believe we control. It forces us to ask, what happens when this logic failure manifests in the power grids or global supply chains or autonomous infrastructure? We're constantly building faster, more intricate systems, and we have to always remember that the tools designed for safety can become the weapons of our near destruction if they operate without an effective off switch.
The ultimate lesson of Black Monday isn't really about the economy. It's about control and the limits of logic in a complex world. We built the systems, but we discovered we could lose control over them in the blink of an eye. And that is a vulnerability that defines the algorithmic age we live in today.
It makes you wonder, if the circuit breaker gives us 15 minutes to think, how long before the system evolves to execute the catastrophic action in 14 minutes? The race between human policy and machine speed continues.
A perfect encapsulation of the challenge ahead. Thank you for joining us for this deep dive into the day the machines panicked.